My name is Liliana Rojas Suarez. I'm the chair of the CLAAF, the Latin American Macro and Financial Committee. I'm here to welcome you for our 43rd meeting. It's been a long road, and this is the first time we're doing our presentation in Zoom. Welcome to all of you. In front of you, you have all the participants of CLAAF. We have a couple of news. First, we'd like to welcome our new member, Andres Velasco. Hi, Andres. Thank you very much for joining us. We have another member, Carmen Reinhardt, that for the moment is on leave from CLAAF because she's taking the position of the chief economist at the World Bank. Joining us, you know everybody, but still I'm going to name them, is Laura Alfaro, the Warren Albert professor at Harvard Business School. She, as you know, was a former Minister of National Planning and Economic Policy in Costa Rica. Guillermo Calvo, professor at Columbia University, former chief economist at the Inter-American Development Bank. Augusto de la Torre, former chief economist for Latin America and the Caribbean at the World Bank, and former governor of the Central Bank of Ecuador. José de Gregorio, professor of economics from Universidad de Chile, former governor of the Central Bank of Chile and former Minister of Finance. Roque Fernandez, economic professor at UCEMA University and former Minister of Finance from Argentina. Pablo Guidotti, professor of the Government School, University Torquato Di Tella, and former Vice Minister of Economy in Argentina. Polo Leme, executive in residence professor in finance in Miami Business School, University of Miami, and former high-level executive and managing director at Goldman Sachs. Enrique Mendoza, the presidential professor of economics at University of Pennsylvania. And well, Andres, we all know that he's the dean of the School of Public Policy at the LSE and also former Minister of Finance of Chile. So the idea of this meeting is that we'll share with you our presentation, our conclusions from the meetings that we've been having over a number of Zoom meetings. In the past, we used to do it in person, but now we've been meeting 4 times actually via Zoom. And we have produced a report that I will tell you where to find at the end of this video, but it's already posted in our CLAAF web page. And so without further ado, why don't I move ahead and share my screen with you to tell you what the conclusions of our deliberations. So bear with me. All right. Hopefully everybody can see it now. And well, this is the name of the statement. Is basically proposal for an effective response. So let me, for some reason, I cannot move it. Let me stop sharing and try again.
Yeah, try full screen and there should be an arrow on the left bottom.
I have full screen, but it's not moving. The PowerPoint is not moving.
There should be like a left and right arrow at the bottom left.
No. Let me check again. Okay, great. Thank you. So we all know how COVID-19 has been a huge shock, but in Latin America for the world. But for Latin America in particular, we had the effect that was a combination of a number of, it was not only the health shock, but the collapse in trade, in commodity prices, in tourism and remittances. And this combined with structural deficiencies in the local markets in Latin America, especially the large informal sector. If you see the graph on your right, you see an index on informality in the world, and Latin America is shown as having the worst degree of informality in the business sector as a region. So this has posed significant challenges for an adequate response, and which of course has been exacerbated by the prolonged lockdowns, which have had significant demand and supply disruptions. Now, in the view of the committee, Latin America response has been insufficient, not only in the health reaction, but also in the fiscal, monetary, and the financial areas. And this is particularly grave, severe for the region, because when we look at how are the forecasts for Latin America around the world, the graph on your left shows the latest World Economic Outlook from the IMF projections for 2020, and you can see that the largest expected decline is on Latin America precisely, with a decline of over 9% of GDP in terms of economic growth. Most interestingly and important is that the forecast that the multilateral organization have been presenting for the region, the graph on your right, shows how, as time has been passing by, the forecasts have actually been declining in terms of the economic growth. So our expectation is that actually the economic growth forecast is at a minimum right now, as opposed to the maximum level. It will be keeping updated for the worst, not for the best. In this environment, we estimate, and this is an estimate of the committee and perhaps our first conclusion, that on average, the response that the public sector would need in Latin America is equivalent to about 10% of the region's GDP. That's the response that we expect will be necessary to tackle the crisis. Some people argue that, well, no, that's too much because you are already adding to existing fiscal deficits. But let me tell you the reasons why we believe the number needs to be high. First of all, Latin America needs to avoid the collapse of healthcare systems, which in some countries are doing really poorly. Second, we need to provide liquidity to vulnerable families during the lockdown. Third, and this is very important, is avoid the permanent structures of firms that are viable. Most of the productive capital of the firms is actually based on the relationship that the firms have established with their whole network, suppliers, creditors, and most important, with the workers it has hired and trained. So this is a relationship that can be permanently destroyed, especially if there is a forced and unduly fire of workers. In that case, we would expect that the economy in general, and not only firms in particular, productivity will decrease. Now, the liquidity constraint is more severe in small firms in the service sectors, and especially in those that are informal. One of the most important reasons, and we know about this, is that this sector does not have assets to pledge as collateral, and so the access to credit is even more difficult. Now, if you see the graph on your right, this is our representation of how without a liquidity support, a strong liquidity support, a vicious circle may emerge. First, firms' capacity to pay wages and service debts will decrease if there is no service support. Well, if the firms are actually not being able to pay wages, households' capacity to pay debt services decrease. But in that case, both because firms and households are having problems with paying debts, there's going to be a deterioration in banks' loans portfolio, which would imply a credit crunch and high insolvency rates, which of course, if we have a credit crunch, will go back to the circle on firms having less capacity to pay wages and service their debt. So this is the reason why the multiple reasons why we think that the response should be really large. Now, for a large crisis and a large problem, you need a large response. And the spectrum of policy actions also needs to be broad. So we have a number of recommendations about what needs to be done. Some of these have already been done by countries, but not by all of them. And let me quickly go through them. First is the direct income transfers to support poor families. This has been attempted by most countries in the region, but not many has been fully successful because of the informal characteristics of Latin America that I just mentioned and the difficulties of the governments to make available that money to families. So even though the intention is there and the programs are there, the execution of those programs has not been successful in the large majority of countries. There are exceptions, but not in the majority. Now, of course, we also are thinking about wage subsidies to allow both that business vicious circle that I just explained to you, but also government guarantees. Now, government guarantees present an important dilemma. When government guarantees, and you know how they work, right? I mean, basically, the government guarantees that if a firm or a household does not make a payment, but usually is directed to firms, if it doesn't make a payment, the government will take that payment into their own account. But it poses a dilemma, and if the guarantee is too small, basically the banks that are receiving the offer to actually extend the credit, there will be no uptake. The banks are not interested when the guarantee is too small. Why take the risk? Well, even if the government pays part of it, why make a loss? So they will not take it. But if it's too big, if the guarantee is too big, then we have the opposite problem, and is that the banks may actually not do a correct assessment of credit, and then credit might be directed to customers or to clients, borrowers that are too risky. So these instruments needs to be properly designed, and it's not easy to design them. With a lot of discussion within the committee, we saw that some countries could cautiously use public banks to actually provide short-term credit in cases where private banks are actually not able or are not capable or not willing to actually extend credit to those sectors that the government thinks are needed. But we don't think that these recommendations apply to everybody, because in cases that public banks, the governance of public banks is weak, then we think that that actually brings a larger problem, which could be quasi-fiscal deficits, in that the government will have to take the liabilities of these public banks. Now, the crisis, we believe, is going to be deepening in terms of economic terms. And so as the government, as the crisis deepens, we have to have in place other additional mechanisms. The first one is the government needs to consider establishing long-term loan guarantees programs and recapitalization funds, because there are viable firms that are going to be needed to be recapitalized, that we don't want, and the government and the social welfare function will tell you that we do not want these firms to go bankrupt. Now, where will the money come? Well, we believe that that Latin America should set in place capitalization programs to be set up to attract foreign equity funds. but that might not be enough. So relying on the private sector arm of multilaterals, such as the IFC and the IDB Invest, could actually play a catalytic role in attracting private investors, and also will foster better governance in the region. That's from the point of view of government programs. But also, we need new legal frameworks, new legal instruments, such as corporate reorganization frameworks, because there are going to be bankruptcies. It is almost impossible to avoid in a crisis of this nature. And so there has to be a burden sharing in order to make viable the enterprises that are going to continue functioning, as well as to be able to close those that will not. So there is going to be a need for a burden sharing between among private stakeholders, which of course include the stockholders, the labor, the creditors. So all of them needs to be within a resolution, new resolution framework. Ecuador is an example of some ideas, and I will ask later on to Augusto to kind of tell us a little bit more about that. Now, the region is very different, right? I mean, I guess that when I've been talking, and if you come from different countries, you could say, well, that doesn't happen in my country, and you could say, well, this is precisely what happened in my country. But the truth of the matter is that we do not think that the capacity of response of the region is just similar across countries. It's actually, there are huge differences. I'm not going to go through this, but basically you can classify countries according to their monetary and fiscal space. And the graph on the right just gives you an idea. What you have here is the MB spread to measure a country risk position of countries, and these are the Standard & Poor grades that are being attached to countries, and the ratings. And what you can see is that there is big variations, with Chile and Peru are among the ones with the lower MB spread and higher ratings, and then it keeps moving up, and Latin America is all over the place. But an important point that we want to stress, that even the strongest countries in terms of macro, which right now appear to be Peru and Chile, do not have the capacity in the same way as advanced economies do to actually produce a solution for the crisis. The advanced economies have much deeper fiscal pockets, and the most important thing, can issue hard currency. And therefore, they are in much better position than Latin America to solve the crisis. So how to fund the policy response? So far, I've been telling you why we need a huge policy response. What are the instruments that should be in place for dealing with that policy response? But how to fund it? Well, we think that the first things first. We know that this is going to require a large fiscal effort. But for that fiscal effort to work, then we also need the government to share the burden of the effort with the private sector. And basically, the government should cut as much as possible non-essential expenditures. So, all right, so you try to cut fat from the government expenditure, and then the question is, which way do you go to fund whatever needs to be funded for these expenses that the government needs to do, or for cutting in taxes? Do you issue more debt? Well, after a lot of deliberation from the committee, we are not so supportive of increasing the ratios of government debt to GDP. Even though countries right now are having significant access to international capital market, we know that there is a lot of volatility and that can change at any moment in time. First of all, the pandemic is still evolving in the world. And so we really don't know what the risk sentiment of international investors are going to be. Instead, we think that there is room for more active central banks. Well, there is a window of opportunity that has presented right now because there is an increase in the precautionary demand for money. And because of that, the central banks can accommodate that increased demand with no inflation. And so that provides some synergy as an additional source of finance, especially in countries with limited or no access to capital markets. Now, although we know and we recognize that there is more room for quantitative easing, we're also aware, and we've been having a lot of discussion about this, that a monetary expansion does not necessarily mean more credit, right? I mean, people can just hold as opposed to actually provide the credit for it. They just can hold the liquidity that is comes from the expansion. And also, we are very aware that central banks should be very mindful of the inflationary risk. The risks have not disappeared, which basically means to avoid stabilization policies, both monetary and foreign exchange stabilization policies. But the bottom line of this discussion here is that the committee believes that if you're facing a trade-off of unsustainable debt accumulation and moderate inflation, the balance of risk now tilts in favor of a more active role of central banks, which might increase the level of inflation, but at moderate levels. But of course, any signal that there is some increase in inflation beyond what is comfortable for the central banks, the policy would need to be reversed. So that is from the point of view of the domestic response. What about the external response? We don't think that the domestic response is going to be enough. As I just mentioned, the capacity of the governments in Latin America is much lower than that in advanced economies. So we basically think that I mentioned that the response should be around 10% of GDP, the fiscal, and this is based on announced fiscal space packages announced by a number of countries like Brazil, Chile, and Peru. So what if we assume that between a third and a half of the financing needs of the region is taken by the international financial institutions, okay? In that case, our recommendation is that the IMF should make available to the region resources that are in the range of 200 to 300 billion to finance the response. So I've explained part of how part of the domestic response could be. This is the external response, and this is a number we came. Of course, it's a number, it's a range, and it's a calculation. There could be a lot of discussions about this, but more or less, this is the bottom line. Now, of course, when we talk about this, we also think that we need to revise the criteria about how this liquidity assistance should be provided, and the conditionality that should come with these loans. One big fear that we have is that you could provide, or the multilateral organizations could, on the one hand, provide financing to the countries, and if the right response is not being in place in the region, that could just fuel capital flight. So it's not that the external finance should just come from the multilateral organizations without conditionality. We think that there should be conditionality so that the money gets, the funds get to where the targeted recipients are. Now, finally, there's been a lot of proposals about whether there should be a debt moratoria or not, whether there should be different ways of increasing the amount of resources the multilateral organizations have. And yes, we agree with all of them, we support them, but at the same time, we think that if they are not properly implemented, there could be innocuous and sometimes even counterproductive. Let me just finish, not by explaining this, but by and the reason why I don't really want to explain this too much is because we have already over and over again put in a number of former statements of past statements of CLAAF, raised these proposals for the creation of a Latin America, a regional Latin American liquidity fund, which we think that could be constructed, built up on the basis of an existing institution, FLAR, the Fondo Latinoamericano de Reserva, that needs capitalizations from the large countries in the region. And the second one, which we've been supporting for a significant amount of time too, is a facility that we call the Emerging Market Fund, the EMF, that aims to stabilize an index of global or regional, better, sovereign emerging market funds. So this is a facility for stabilizing the fluctuations in these emerging market bonds. Now, think about what would have been if the EMF would have been in place before the eruption of the coronavirus crisis. In that case, it could have been the case that while fluctuations in emerging markets, capital markets that we observed could have been attenuated, mitigating the effects of flight to quality. So this is basically, in a nutshell, the recommendations and the conclusions of the committee. You can find the statement. They are already in our webpage, as I mentioned, claaf.org/statements. And they are also posted at the Center for Global Development, cgdep.org/Latin America Initiative. All right, with this, let me stop sharing. And I'm going to ask a couple of the members of the committee to expand on some of the issues that I've been discussing. And then we'll open to the overall questions by participants. So first, I would like to ask Andres to please, we had these conversations during CLAAF about how important it was to maintain the viable firms going on, and how the capital of the firm was so much related to the relationship that it had built with their trained workers. Could you please explain a little bit further to us on this?
Thank you, Liliana. Thank you, everybody. Delighted to be here. And congratulations to the committee for an outstanding and very useful declaration. Let me elaborate a bit on the point that Liliana just mentioned. The coronavirus shock is a big shock. We hope it is not a permanent shock. So the question that has to be on everybody's minds is, how do we make sure that the largest feasible number of firms makes it alive through the shock? Clearly, there are some sectors, particularly if the crisis brings structural change and if the crisis drags on, there are some sectors where firms that used to be viable will no longer be viable. And what policy calls for then is restructuring, and there's a role for fiscal policy in particular in helping restructuring. But much more important than that are the hundreds of thousands or perhaps millions of firms that were viable before the shock, that are in all likelihood going to be viable after the shock, but which for weeks or months or as long as half a year have had almost no income or no income at all. Think particularly of firms in the service sector, say, which were entirely and totally unable to operate not because they didn't want to, but simply because government policy was to keep them shut and send the workers home. That firm, on the one hand, has no income, but it has expenditures. It has to keep paying workers, it has to keep paying suppliers, and it has to keep paying the bank or creditors if the firm has debts. If the firm is left without any cash, it will default on workers, it will default on creditors, it will default on suppliers. The payments chain in that country will be broken. There will be multiplier effects that we would like to avoid. But most importantly, entrepreneurial and productive capital will be wasted, because that firm is not simply the physical capital, the infrastructure, the machinery. The productive capital of a firm is the team of human beings that the managers first identified, then recruited, then trained and made into a team. And because of pure liquidity constraints, lack of cash, the management could be forced to fire those workers, which is of course terrible for the workers, but it's also terrible for the firm, because when the economy picks up again, when lockdown restrictions are lifted, that firm will not be able to ramp up production. It will be either gone or much less productive than it was before the crisis. And this brings social costs, it brings individual costs, and it makes the economic recovery much, much slower. So what do we need? Clearly, if expenses are still ongoing, but income is much reduced, we need credit. And of course, if credit markets were perfect and the firm is in fact viable in the long run, the firm could say, well, I will have profits in the future, lend to me against those profits in the future, and all would be well. But of course, capital markets don't work that way, because banks or lenders do not lend against the promise of future profits. They lend against collateral. And as Liliana said in her statement, typically the firms that have the least collateral are the smaller firms in the service sector, which are the most affected by the lockdown and by the crisis. So this is a prima facie strong case for a public policy intervention. And this public policy intervention must have several components. One necessary but not sufficient component is to have ample credit, for instance, originating in the central bank. And several countries in the region, Chile as an example, have seen central banks take up a very aggressive role in providing credit to the banking system so that banks can in turn roll over the debts of businesses in this situation. But while the provision of credit is a necessary condition, is not sufficient, because the banks will lend to those firms that are viewed to be viable. And clearly, there's a huge potential for self-fulfilling pessimism here. If a firm is viewed as viable, then it will get a lot of credit. Because it gets a lot of credit, it will stay current with suppliers and employees. It will not fire anybody. Then the firm will be, in fact, creditworthy. That's a good outcome. But if a firm, for some reason, comes to be viewed as uncreditworthy, then what will happen is that lenders will not lend. It will be forced to fire workers. And as a result, it will be a self-fulfilling prophecy of the bad kind, because having fired workers, the firm will indeed be unprofitable, and it will indeed not be deserving of credit. So you also need a fairly active role by regulators, potentially by state banks, by other non-bank lenders, to make sure that that credit that is available, perhaps from the central bank, gets to firms. And here, and I will end here, there may be a role for some of the other policies Liliana mentioned. Provision of credit is one, provision of partial guarantees is other, and Liliana explained very well what the pros and cons are of that policy. And in extreme cases, particularly of larger firms, the taking of equity stakes and exercising control is also an alternative. But bottom line is, we want to save firms because we want to save the productive capital of economies. This needs credit, and to ensure the credit gets to firm, we need a very activist macroeconomic and microeconomic policy. Thank you, Liliana.
Thanks, Andres, so much. To participants, please don't forget to send your questions using the chat feature. Augusto, I mentioned that Ecuador is kind of doing a novel approach to reorganization and a new legal framework. It's establishing a new legal framework for the reorganization and restructuring of firms. Can you tell us a little bit about that? Because I think that there was a number of countries in the region that may want to take a look at their current legal frameworks, and perhaps what Ecuador is doing right now could actually provide for a template.
Yes, thank you very much, Liliana. Very happy to be here. What Ecuador did through a congressional legal approval recently is complementary to what Andres was saying. One of the big issues we have under the current crisis is that it's very hard to discern and to separate viable firms from unviable firms. That's a tough job for bankers, it's a tough job for the government, it's even difficult for the entrepreneurs themselves who have a lot of uncertainty about the future viability of their companies. So one possible solution is for the government to take a lot of risk and to take a lot of costs to try to save as many firms as possible. But some countries like Ecuador are unable to put all of these risks and costs, and they shouldn't, on the shoulders of the government. So this legislation essentially encourages the stakeholders to a firm to share in the sacrifices to adapt the firm in a way that the firm remains viable. That requires three elements, essentially, which are contemplated in the legislation. The first one is an incentive for people to negotiate common sacrifices and burden sharing between workers, creditors, suppliers, renters, shareholders, managers. And to do that, what you have to do and what this legislation does is it creates a very easy path for liquidation so that everybody knows that if there's no agreement, there's no cooperation among stakeholders, the firm will go into a very quick, decent liquidation. It will die in peace, so to speak. So that's the stick, so that people are encouraged to cooperate. And then the carrot for people to cooperate is that if firms come to agreements between workers, suppliers, creditors, shareholders, etc., to make the firm more viable by making common sacrifices. For instance, workers can reduce their wages or their hours worked. Shareholders can commit not to distribute profits. Creditors can commit to provide extensions or some debt relief. If they come to an agreement which is easily documented, then the government offers credit support to those firms that have reached an agreement. And that's the carrot. So you have a stick and you have a carrot. And in the middle, you have a number of procedures that encourage cooperative solutions. For instance, you can choose a mediator. The mediator can quickly come to an agreement. You don't have to go to the judges. You can do it out of courts. You can trade off efforts made by workers as long as creditors also put some effort. So these cooperative solutions should allow firms to adapt to these difficult circumstances by sharing sacrifices among stakeholders and not sending all of the costs and all of the risks to the government. It's essentially kind of an accelerated, efficient Chapter 11 proceeding that happens out of court. Now, of course, if things don't work out of court, the process goes into court.
Thank you so much, Augusto. One of the topics that we discussed for a long time during our deliberations was the issue of, well, should there be a more expansive monetary policy? And I would like Guillermo to expand on this trade-off that we've been discussing on why at this precise juncture, when facing the trade-off between higher debt or more expansionary monetary policy and quantitative easing, you would like to favor the second.
Okay, well, thank you very much, Liliana, and welcome everybody. We've been discussing these issues, and there is no easy answer. Listening to my colleagues, question that comes to mind is, what is the market? We used to be very confident that the markets were basically the solution, the channel, and now we are questioning the market. So once we do that, we really, as macroeconomists, standard macroeconomists like myself, you, in a certain sense, you're out of business too, because this is not the stuff that we talk or learn or did research. But that doesn't mean that we cannot think about it. Now, having said that, I guess one can label the discussion that we've been having as, or label or characterize our discussions as discussions involving a lot of unconventional policies. And here we see examples, I mean, what Augusto said, and all kinds of questions come to mind. However, there is still some credit out there, which may or may not be unconventional, and that it looks very good on paper. And I personally a little bit concerned about the spontaneity with which, for example, the IFIs, the G20, think about, discuss about, and several academics do that, of course, they giving credit to emerging markets in this emergency situation, and that's very good. The concern is, where does the credit go? We have all of these imperfections that Andres and Augusto's presentation make evident. So just having dollars that will come, will that help? Well, the concern is that, because we've seen that in the past, is that the dollars come one door and can leave the other door. And there are lots of very powerful players in these economies, in any economy, that are ready there precisely because there is an emergency to try to find a way to channel the funding outside the other door. So can that happen? Well, it has happened. I'm a little bit concerned that in some cases we may not need external debt that much. If I need to make a peso transfer, do I need dollars? If I need dollars to make that transfer, in what sense do I need it? What's going to happen? Well, certainly if the fisc gets the dollar, we'll go to the central bank and exchange it for the pesos, give the pesos away or give credit on that. The central bank may get concerned, which is very normal, and say, well, be careful, this can generate inflation, especially in our region that has suffered so much from inflation. And I don't blame anybody, that's very conscious of that. So one possibility is to say, no, let me just make sure that this doesn't result in a jump in inflation rate, and I will sterilize that or intervene in the market. What you do, you sell your dollars. Okay, inflation is over, but what have you done? You borrowed dollars, which you really don't need. You could have just lent directly from the central bank. I don't want to enter into detail. So now the question there is, and with this I will finish because it is the bottom line really. Question that arises is, well, we've seen that movie before. I mean, let's be careful. And there are some extreme cases in the region already where we see that going over the board is very dangerous. Yes, no doubt about it. But look at the well. We have a disease, but a disease of deflation. So in principle, the rest of the world, the world prices, you cannot blame them for transmitting inflation to emerging markets. So it's a good time in the first place. And secondly, as Liliana pointed out in her presentation, the evidence is that there seems to have been an increase in the demand for money, particularly in the demand for cash. Quite remarkable, to the extent that Argentina, one of the high inflation countries, have been able to pump in liquidity without causing a runaway inflation. That might, under other circumstances, it would have been because really high power money, I think, increased by 40% or something like that in the few months, the first semester. But you look around and you will see that that happens everywhere, even in the United States is happening. I mean, the demand for cash in the US has increased. No time here to discuss. So that's why I would say, let's take that with some equanimity, be concerned, and that's why we said that's the way we put it in the statement. Yes, don't lose sight of the risk of inflation, but don't get too obsessed with it, because after all, much of the transfers that you have to do, these are peso transfers. So you can go that way, and then as a good policymaker, just look around, see what happens. But to preempt that too quickly might result in international indebtedness. That is the last thing we want, because that's going to be, after all of this, everybody will come back and say, suppose that this virus is over, they say, well, now let me look at your accounts. And that's not going to look good. So highly indebted countries will have a serious problem going forward. So maybe there is some room there to utilize the seigniorage, and that's the bottom line in the paper. Hope I didn't take too much time. Thank you.
Thanks, Guillermo, a lot. I have a number of questions that I will want to pose. So I'm going to ask Pablo to very quickly, please, tell us why we recommend that in this new request for availability of resources from the IMF, we are also pointing out that the criteria for extending those loans from the IMF should be revised.
Thank you, Liliana. Let me first say that, of course, we chose to speak about numbers, about the size of the response in various forms of about 10% of GDP, and then what it implied for the availability or for the effort of the international community, and particularly the fund. Of course, that putting the numbers in a region like Latin America that has a lot of heterogeneity is complicated. So one should clearly understand what we mean by these numbers, and essentially is based on the evidence of countries that have not been restricted in terms of financing and have what we see as the most adequate responses to the crisis, and that is the 10% figure in all of these items. The numbers that we put on the IMF availability of resources between 200 billion and 300 billion essentially implies that we believe that the international community should participate in helping with this effort for about 30 to 50% of the total response. But of course, what we were really worried is if the IMF would have enough resources. So we are not saying you should lend these numbers, but if everybody needed, then what would be the resources that the IMF should have available? And that is the 200 to 300 billion number for the region. And of course, we said this is a different shock than other shocks. This is an exogenous shock that affects everybody. So the conditionality really in this case for the funds should not be linked to previous macroeconomic conditions. This needs a conditionality that ensures that these funds go directly at attacking the effects of the crisis, whatever is health expenditure or this type of subsidies that we have been discussing. And of course, in addition to this, we have to to be aware of what Guillermo was saying in terms of the challenges that foreign assistance, foreign currency assistance implies for the government in terms of, for example, creating an expansion of monetary policy. Let me go also back to a point that has to do with this recommendation of relying more on the action of central banks, and also clarify that the region is very heterogeneous, okay? So when we say the balance of risk has tilted in favor of a more active role of central banks, is because we are worried that in many countries in the region, debt is already high, and higher indebtedness may actually put at serious risk the economy in the future. But say for countries like Chile, and I'm sure Pepo will agree with this may be not the case. And maybe, you know, Chile and Peru are the countries with the lowest debt ratios in the region, and maybe they will see it as risky to rely more heavily on central banks. So I think that we have always this difficulty in making recommendations for a really heterogeneous region, and this is what we have to take into account when interpreting what we say.
Okay, Pablo, thank you very much. The questions that I've been receiving relate to what's happening in the different countries and how countries have actually been responding or doing what we suggested. So very interestingly here, we have, I'm from Peru, but I talk already too much, so I won't. But we also have representation from Mexico, Brazil, Argentina, Costa Rica, and Ecuador. And Peru, we have a good number of countries here. So what we presented to you was a framework, right? We told you what are the problems, what we think governments should do, and how they should fund it. So a question that I have, and I would ask some of you, we cannot cover all the countries, but some of you to try to fit what the country has done with the framework we have proposed. So how is your country doing? I want to understand with a very controversial country, Mexico. So Enrique, the fit between what has been done and what we are recommending. So brief for each one, please, because we don't have too much time. And I would like to cover as many countries as possible because that's what people are interested in here.
Thank you very much, Liliana, for the opportunity. And well, it's kind of being in the hot seat. Let me say something. This being a big committee, sometimes we agree on things, sometimes we disagree on things. I think we agree that there is a lot of heterogeneity across countries. But I'm going to disagree in the sense that there is a lot of homogeneity in some things. And I think that by far, the fact that most of the region is doing a terrible job at containing the pandemic is fact. If you look today at the Johns Hopkins University website, where they track worldwide the COVID, 5 of the worst 10 offenders are countries from Latin America. And Mexico happens to be number 4 in the list. So just to give you some idea of the numbers, Mexico reports 40,000 deaths today. India reports 29,000. But Mexico reports 356,000 cases, whereas India reports 1,200,000 cases. So that gives you an idea of the scope that with such a much smaller reported pool of cases, Mexico reports such a large, almost twice the size number of deaths. Relative to Chile, Mexico reports almost 4 times the numbers of deaths on a similar number of infections. But that is because Mexico is hardly testing. The Undersecretary of Health in Mexico has come out to public saying that testing is not useful. So Mexico is not testing. So even these numbers, as dire as they are just an underestimate of what's going on. But as I was saying, if you go to the Johns Hopkins website, you will see there Brazil, you will see there Colombia, you will see there Chile, you will see there Peru. Now, of course, it is very difficult for countries that are in the situation that we have described financially to respond with the same kind of severe lockdowns that some of the advanced economies have responded. In Mexico, the reason the management of the pandemic has been weak is because the lockdowns have been weak. So in a way, Mexico ended up in the worst case scenario where we did economic damage with the amount of lockdown that we had, but the amount of lockdown that we had was too weak to contain the growth of the pandemic. So now we're talking about the hospital system being about 75 to 80% close to capacity. And that is a number to be very worried about because it means that that's the entire capacity of the health system. So it means that there is very small margin to attend for anything else but COVID in the health system. Now, the response on fiscal policy has been super weak. So if you compare, there's a recent report from the IMF in the update of the World Economic Outlook in June that shows across countries, again, the size of the fiscal response. And Mexico's response is about 1.2% of GDP. This is direct deficit creating payments, as opposed to what other countries, particularly in the advanced world, has done, which are way over 10% of GDP. On the financial and monetary side, the response has been a bit better because there has been a lot of creative activity in extending repurchase agreements to longer maturities of government securities, on enhancing the capacity. So now there are repurchase agreements of corporate securities. The swap facility with the Federal Reserve was activated. All these things are useful policies. But by far, still the challenge in Mexico remains today the containment of the pandemic. And I believe that that is also the main challenge in many of these countries. So it may, and this is where I close, it may be that we arrive at December or January, vaccines and inoculation campaigns get started. By then it will be too late for a lot of these measures to try to contain the growth of the pandemic, and the social cost of not having been able to contain the growth of the pandemic would have been incurred.
Thanks a lot, Enrique. Well, why don't we move now to another extremely contentious country, Brazil. As you all know, there has been, this is another president that has been in the press quite frequently, and now he has coronavirus. And the handling of the pandemia has been very criticized too. So Paulo, can you briefly tell us about how our framework fits with what the government of Brazil is doing?
Sure, Liliana, and good afternoon, everyone. I think that that's the only main thing, for example, that Brazil has in common with Mexico, where I think, like in finance, I mean, you have to use leverage, and leverage is good management, and we have not had good management, particularly in terms of public health, in terms of leadership and coordination across different levels of government. When you go to our recommendations in terms of stimulus, both in terms of monetary credit and fiscal, it has been quite extensive. I think particularly in terms of monetary and credit policy, the liquidity expansion thus far has amounted to just under 17.5% of GDP. And the credit expansion has been towards 20% of GDP. And you can see that it's not just concentrated in large firms, it also trickling down also to small and medium-sized firms. So I think that the central bank's response, I think, has been large, timely, and adequate, and banks are lending. In terms of fiscal, I would say that given its constraint, because it's overly indebted, I think it has been quite large, second only to Chile and Peru, 7.3% of GDP, doing the things that we're recommending in terms of social transfers, wage support, unemployment compensation, and things of that sort. So to summarize, I think that obviously every country could have done more for such a horrendous situation in which we're in. But to me, if I were to ask to change, one big thing is leadership and management.
Great, Paulo. We have a question about whether the government should implement tax reforms to give the government more public funding. Does anybody in the group would like to take that question?
I mean, I could start. I would say, I will
Sure.
tell you specifically what's happening in Brazil. They're taking the opposite direction. I would say they are trying to improve the tax system, including there's a tax reform going on, but it's not a revenue enhancing reform. And the idea is now to try to look back, try to make sure that some of this increased spending does not become permanent. And I would say in the past, probably the solution would have been tax. But I would say that there's a tremendous caution by this current administration, particularly the Minister of Finance, not to go in that direction.
Okay, great. Paulo, Enrique?
Just to add very quickly to that point, this is some research that we're actually working on right now, is to look in the aftermath of the COVID. Many of the countries are going to have very large problems with the debt and expansion of the fiscal deficit. So the discussion of the financing connects with the discussion of taxation and the forms of taxation that you can use more effectively. Now, there are two dimensions to the question. So when you're in the midst of the pandemic, the issue is really more about the provision of liquidity, which is what we have been emphasizing a lot today. So from that perspective, it's the opposite. You do not want to increase taxes. You want to defer the collection of taxes and keep as much of the funds as you can in the hands of the public and the firms. So on impact, what you will want to do is to move in the opposite direction. In the long run, it's about fiscal capacity. This question of fiscal space is more about the extent to which you can generate long-term primary surpluses in order to finance debt over time. And that's really where the weakness of Latin America and a lot of the developing world and emerging markets is that their capacity to generate sizable primary balances over the long term, at least in the perception of the markets, is rather weak. So that puts them at a disadvantage. And if you do have to think about tax reform in that context, you have to think very carefully about the taxation of capital, because the taxation of capital causes a lot of inefficiency in the economy. And in the world of integrated capital markets, it also causes capital outflow.
Thanks, Enrique. Let's now move to a country that was doing very well until relatively recently, and then, well, now is not so much so. And so, Laura, why don't you talk to us about Costa Rica and how is it fitting our framework?
So as you mentioned, Costa Rica is interesting because in health was doing relatively better, and I would say in the economic and social side, relatively worse than some other countries. In the health, I think that the government inherited a health system that allowed it to contain some of the pandemic, but I think the government claimed victory too early and also miscalculated the risks of contagion from many sources. In particular, our neighbor in Nicaragua, the government is one of those in Latin America that has done nothing, not even acknowledged the health problem. And in Central America, there are a lot of migration flows, and I think the government mismanaged and miscalculated the effects of this flow. And so recently, the cases have increased and the mortality has increased. I still think it's in a manageable levels, and I do hope that the government thinks a little bit more seriously about that. In contrast, we have the economic and social situation. So Costa Rica is one of those countries that came to this crisis with absolutely no fiscal capacity, no economic plan, no economic strategy. If you look at indicators in Costa Rica, productivity has been zero, productive investment has not increased. We recently increased taxes. So we recently had a very comprehensive tax reform. And the outcome of that tax reform is the fiscal deficit ended at 7% of GDP. So we came to this crisis with a very responsible fiscal situation and ever increasing deficits and debt. And for the last 6 months, the government has no plan, no strategy, other than, as was mentioned, to go abroad and solicit loans. But again, it's not clear what this money is going to be used for. There's already concerns that some of the money that is being targeted to the poor is not going there. So I do worry about the capacity of the country of using all this money, and I'm talking 6-7% of GDP, with little transparency. So again, a call for transparency. And in terms of the heterogeneity, Costa Rica is one of those countries that I do think IMF should pay a little bit more attention in terms of conditionality. It's a country that is easy to sleep, not to count. It's a small country. You can give them money and it will be fine. But it will end this pandemic with a very high fiscal deficits and debt and a history of no capacity to deal with it. The other problem that all of Latin America is facing, and again, we're not experts, but I think we should mention it, is we're going to have a lost decade in terms of education. At least my country last year, for different strikes, kids didn't finish school. This will be a year where they don't finish school. And Latin America, we also have huge disparities in access of internet and Wi-Fi. At least in Costa Rica, the government doesn't seem to be interested in trying to solve that. And so if we continue this year, the way we're going, we're not going to have school. It's most likely we're also not going to have school next year. So we're going to have a generation that will go 2-3 years without any school. We know from the 80s that was devastating for a generation. And I think all of Latin America is going to face that. Again, we're not experts, but this is something that we should pay, the people in charge should pay a little bit more attention.
Thank you so much, Laura. Now let's turn to Chile. The country has very strong macro data, at least before the initiation of the crisis. But now there is a lot of controversial proposals in Congress that may actually difficult the solution. We would have expected a country like Chile to react much faster and energetic than most of the others. So, Jose de Gregorio, Pepo, for us, could you please comment on the situation in Chile?
Yes, first of all, the health situation, it's sort of similar, although different in magnitudes, to Costa Rica. At the beginning, there was some control, but then it deteriorated a lot. And the deterioration is also linked to the especially in poor neighborhoods, the way as people live, the crowded homes. So we had a sharp deterioration, and starting from a situation in which authorities expected to reopen the economy soon, we have been more than 2 months in full lockdown in Santiago. So it has been quite costly in economic terms. Now, I think from an economic point of view, the central bank deploy a wide range of instruments to secure liquidity, to improve the funding of banks in order to lend to the corporate sector. Credit to the corporate sector in Chile is growing at 2 digits. That is a lot of precautionary borrowing by many companies. There is a wide program of government guarantees from small and medium enterprise. So you are right. Chile entered the crisis with a strong fiscal position, but in the context of a social crisis. So we had the mix of a strong macro, but with extremely weak and friction political and social system. And what happened is that also the government has been doing a lot of policies in terms of helping the families, helping different groups of people, workers. There is a law to protect employment based on a system of employment insurance that we have for many, many years. So many firms have been able to furlough their workers, and the workers receive the employment insurance that they have accumulated, complemented by social safety net. However, the main problem, I think, that within the crisis has been of implementation and of delay in the support. So basically, support comes after a month, several weeks of lockdown to families. They are thinking in programs for the whole population, especially the middle class. This was the reason why there was a lot of pressure, and it's being approved in Congress, the possibility of withdrawing 10% of your accumulated money in the pension funds. which of course is pretty bad for the pension system, but for many families is quite important. Now the discussion and the devil is on the details. And most of this, I think, that has been one lesson from this crisis, I would say, is that when you have, it's not just the magnitude, it's not just the type of policy, it's also the opportunity. And if there is a thing that in Chile has been a complicated, I think, has been the delay with which the measures have been implemented, and also with the uncertainty that we have, because we really don't know how all these policies have been reaching the people. Which, of course, these have added to the social tensions in the country. So now we are in a sort of a political and social crisis with a lot of lack of leadership and discussion of a range of policies.
Thank you, Pepo. Before moving to, I want to include Argentina too in the discussion, but before that, we have an interesting question about how countries without their own currency can better achieve greater fiscal space. So since this is the case of Ecuador, Augusto, do you have a comment on that?
Sure. Ecuador, in this heterogeneity of Latin American countries, lies at one of the extremes. It has very, very restricted capacity to provide a fiscal response. So in the case of Ecuador, burden sharing is not an option. It's the only way to go. Everybody has to share the burden because the government has very limited ability to assist the public sector. So what has happened? You have a country that doesn't have access to markets, that has a fiscal crisis because it was already in fiscal problems, but then with the collapse of oil prices and other income, government revenues have fallen like a rock. And it cannot print its own currency. Therefore, it cannot take advantage of possible spaces like the one Guillermo was mentioning, where people may be more willing to hold local currency in these circumstances. So Ecuador cannot take advantage of that. So it has to work in several fronts, but the way, and this, of course, stretching the capacity to resist of democracies to come to consensus, but this is what Ecuador is trying to do. On the fiscal side, it has cut all spending expenditures, and it has reoriented expenditures towards cash transfers to the poor. So one of the good things the government did from the beginning was it expanded the coverage of the cash transfer program. It used to cover about 20% of the Ecuadorian population. Now it's covering close to 40% of the Ecuadorian population, but the coverage is very small. Households get a $60 check every month. So $60 is enough to eat, but not more than that. Secondly, it has had to make space for a response in the health sector, which has been very difficult because of the constraints and because Guayaquil was the city that was most hit by the crisis initially. And since then, I think that the efforts to control the pandemic have been relatively good compared to other countries that have more resources. Third, it cannot pay the debt. So Ecuador has been forced to renegotiate the debt with external bondholders. It has already achieved an agreement in principle with a majority of bondholders, which is good. It provides 10 years of significant debt relief to Ecuador and moves the debt payments towards year 10 to 20. That's pretty good. And it has no other choice but to secure external funding. So this is one of the cases where, to go back to Guillermo's intervention, this is one of the countries where external resources are essential. Ecuador is getting asphyxiated by the lack of external resources, the lack of dollars. Dollarization needs dollars to work, and the dollars cannot be printed. So they must come from abroad. Either you save dollars by making debt renegotiation arrangements, or you go to the IFIs, the IMF, the World Bank, etc., to get dollars. And that's the name of the game for Ecuador. With a complication that we all know that after this crisis, we need to do a lot of reforms, including tax reform and other things. And the question for countries like that is whether democracies can deliver the type of social consensus that's needed to walk through these dark times together. instead of splitting apart.
Thanks a lot, Augusto. So now finally, well, Argentina. Well, the country is swamped in problems. Before the crisis already had a huge debt problem. Economic growth was faltering. And so it would be great to hear your views, Roque, on how Argentina is doing in connection to the framework that we suggested in the statement. You're muted.
Okay, can you hear me? Yes. Okay, in the framework that we were discussing, of course, that Argentina is a sort of outlier because we are actually in default. We are in the process of negotiation a way out of default. And in terms of the tax reform that was mentioned in one of the previous questions, actually the recession that we started in Argentina in the first quarter of 2018, it was due to the tax reform. So Argentinians having a problem of fiscal dominance in the previous year, they decided to put a tax on the yield of financial assets, okay? And so that it produced a sudden stop, self-inflicted sudden stop in Argentina, where we have a lot of capital flight, and of course, we started the recession that went through 2018, 2019, and 2020 in the first quarter, where nothing had been done at that time, and we got the coronavirus, the COVID, producing a further recession in Argentina. So if we measure what is the situation of Argentina today with respect to potential output, in the sense that it is something that we economists pay a lot of attention, we are far away of potential output. I think that we may be more than 20% below of the potential output, and at the time that we are now. So if the COVID keeps hitting us, probably we are going to be more than 20% below the potential output. So that's the situation. We don't have fiscal space, so we are just printing money. And as you mentioned in the statement, Liliana, you mentioned the case of sterilization. And this is a case where Argentina is different or have some difference with other countries because we don't have space for printing debt. So what the central bank is doing, that is trying to sterilize printing debt instead of printing money, it is doing that with a huge nominal interest rate. So it's not the case that you say, well, it's a good idea to go to the capital markets because interest rates are close to zero. That's not the case of Argentina. So I think that sterilization is not a good idea in our country. It may be in the other countries where you can manage fiscal policy and debt policy, but it's not the case of Argentina. So that is the situation. I think that in the recommendation of the committee where we are talking about being cautious about the possibility of using sterilization, I think that that paragraph includes Argentina.
Okay, well, I think we are out of that time now. Our audience has been really patient with us because we are close to half an hour beyond the time we have originally scheduled. But there is always a lot of interest in the region, and I hope that we have been helpful to your understanding and discussions about how to deal with the pandemic. So with this, I just want to say thank you again, and very hopefully we'll meet again for the 44th statement of the committee. And so thank you, and goodbye for now.